Bitcoin, the world's first decentralized digital currency, has been a hot topic in the world of finance since its launch in 2009. Created by an anonymous individual or group using the pseudonym Satoshi Nakamoto, Bitcoin has become a popular investment option for people all around the world. With its potential for high returns and its unique features such as decentralization and anonymity, Bitcoin has captured the imagination of investors and technology enthusiasts alike. However, as with any investment, Bitcoin carries risks, and it's important to approach it with caution and do your own research before making any financial decisions. In this script, we will explore the basics of Bitcoin and its impact on the world of finance. Bitcoin is a decentralized digital currency that allows for peer-to-peer transactions without the need for intermediaries such as banks or financial institutions. This means that users can send and receive funds directly to each other without the need for a middleman to verify the transaction. Bitcoin transactions are recorded on a public ledger called the blockchain, which is maintained by a network of nodes. When a user sends Bitcoin to another user, the transaction is broadcast to the network, and the nodes work to verify the transaction by solving complex mathematical equations. Once the transaction is verified, it is added to the blockchain and cannot be altered, making the system highly secure and resistant to fraud. Bitcoin is a finite asset, with only 21 million Bitcoins ever to be created. This limited supply makes it a scarce asset that some investors believe will increase in value over time. The value of Bitcoin is determined by supply and demand on the market, and it can fluctuate wildly in a short period, making it a highly volatile asset. One of the key features of Bitcoin is its anonymity. Transactions on the Bitcoin network are pseudonymous, meaning that users can send and receive funds without revealing their real-world identities. This has made Bitcoin popular among people who value privacy and want to keep their financial transactions confidential. In summary, Bitcoin is a decentralized digital currency that allows for peer-to-peer transactions without the need for intermediaries. It is recorded on a public ledger called the blockchain, and its limited supply and anonymity have made it a popular investment option for people all around the world. However, it is important to remember that Bitcoin carries risks, and it's important to approach it with caution and do your own research before making any financial decisions. Bitcoin works through a network of nodes, which are computers that maintain a copy of the blockchain, the public ledger where all Bitcoin transactions are recorded. When a user sends Bitcoin to another user, the transaction is broadcast to the network of nodes. Each node on the network works to verify the transaction by solving complex mathematical equations. This process, known as mining, involves using powerful computers to solve mathematical equations that are designed to be difficult and time-consuming. Once a node solves the equations, it creates a block that contains the transaction information and adds it to the blockchain. This block is then broadcast to the network, and all other nodes verify the transaction and add it to their own copy of the blockchain. The mining process is designed to be difficult and time-consuming to prevent fraud and ensure that the network remains secure. Miners who successfully add a block to the blockchain are rewarded with newly created Bitcoins and transaction fees. Bitcoin transactions are pseudonymous, meaning that users can send and receive funds without revealing their real-world identities. However, the blockchain records all transactions, so it is possible for someone to trace a Bitcoin transaction back to its source if they have the necessary information. One of the key features of Bitcoin is its decentralization. There is no central authority or entity that controls the network, and anyone can join the network and participate in the mining process. In summary, Bitcoin works through a network of nodes that verify and record transactions on the blockchain. The mining process involves solving complex mathematical equations to add transactions to the blockchain and secure the network. Bitcoin is decentralized, meaning that there is no central authority that controls the network, and transactions are pseudonymous to protect users' privacy. So, why is Bitcoin so popular? Decentralization. Bitcoin is decentralized, meaning that it is not controlled by any central authority or government. This feature has made it popular among people who are concerned about government control over their money. Limited supply. Bitcoin has a finite supply of only 21 million coins, which has made it a scarce asset that some investors believe will increase in value over time. Anonymity. Bitcoin transactions are pseudonymous, meaning that users can send and receive funds without revealing their real-world identities. This has made Bitcoin popular among people who value privacy and want to keep their financial transactions confidential. Low transaction fees. Bitcoin transactions typically have lower fees than traditional financial transactions, making it an attractive option for people who want to send money internationally or make small transactions without incurring high fees. Accessibility. Anyone can participate in the Bitcoin network and buy or sell Bitcoin, regardless of their location or financial status. This has made it popular among people who do not have access to traditional financial services or who want to invest in an alternative asset. Transparency. Bitcoin transactions are recorded on the public blockchain, which means that they are transparent and cannot be altered. This has made Bitcoin popular among people who want to ensure that their transactions are secure and free from fraud. Overall, Bitcoin's unique features such as decentralization, limited supply, anonymity, low transaction fees, accessibility, and transparency have made it a popular investment option for people all around the world. However, it is important to remember that Bitcoin carries risks, and it's important to approach it with caution and do your own research before making any financial decisions. Volatility. Bitcoin is a highly volatile asset, meaning that its value can fluctuate wildly in a short period. This makes it a risky investment option and can lead to significant losses for investors. Hacking and security risks. While the Bitcoin network is secure, individual Bitcoin wallets and exchanges can be vulnerable to hacking and cyberattacks. This can result in the loss of Bitcoin holdings and sensitive personal information. Regulatory risks. As Bitcoin is not regulated by any central authority or government, there is a risk that governments could introduce laws and regulations that could negatively impact the value of Bitcoin and its use. Liquidity risks. While Bitcoin is becoming more widely accepted, it is still not as liquid as traditional financial assets. This means that it can be difficult to sell Bitcoin quickly or at a fair price, particularly during times of market volatility. Operational risks. Bitcoin is a complex system that requires technical knowledge to use and maintain. There is a risk that users could make mistakes or lose their Bitcoin holdings due to technical issues or human error. Environmental risks. Bitcoin mining requires a significant amount of energy, which has led to concerns about its impact on the environment. Overall, while Bitcoin offers many benefits, it is important to remember that it is a high-risk investment option. It is important to approach Bitcoin with caution, do your own research, and only invest what you can afford to lose. Despite the risks associated with Bitcoin, it has remained a popular investment option for many people. Its decentralized nature and potential for high returns have made it an attractive option for those looking to diversify their portfolios. However, it is important to approach Bitcoin with caution and do thorough research before investing any funds.